All right, let's get started. Good evening. Welcome and thank you all for joining us. If you've joined our Faculty Live series events in the past, I want to give you a big welcome back. My name's Elisa Douglas, Director of Alumni Engagement and Programs at Columbia Business School. This virtual series brings our CBS thought leaders to you no matter where you are located. So in just a few moments, we will hear from Professor Shiva Rajgopal on a wish list for financial reporting. This talk will highlight areas where U.S. reporting needs to be improved, and it's going to be very fascinating. Over the next hour that we have together, Professor Rajgopal will present, and then we will open it up for Q&A. At that time, I will ask that you please use the Q&A function to submit your questions. Now, a little bit about our thought leader. Professor Rajgopal is the Roy Bernard Kester and T.W. Byrnes Professor of Accounting and Auditing and Chair of the Accounting Division at Columbia Business School. He has also been a faculty member at Duke University, Emory University, and the University of Washington. Professor Rajgopal's research interests span financial reporting, earnings quality, fraud, executive compensation, and corporate culture. His research is frequently cited in the popular press, including the Wall Street Journal, the New York Times, Bloomberg, Fortune, Forbes, and so forth. Now, I would love to hand it over to Professor Shiva Rajgopal.
Thank you so much, Elisa, and thanks to everyone who actually came here for an accounting talk. So, a couple of days before this, I maybe gave Elisa a bit of a heart attack and said, maybe I shouldn't do this, maybe I should do something else. Accounting is kind of boring, people may not sign up. So it's gratifying to see so many of you. Of course, since you're here, you hopefully find the topic interesting. We have 1 hour together. So what I was hoping to do was maybe spend 20, 25 minutes laying out some ideas, and then I'll stop talking, and then hopefully we'll have a conversation. Happy to share the deck. Elisa or someone will share the deck if people are interested. So let's quickly get started and then get into it. So this is roughly the agenda. I'm going to make the claim that what we teach in a high school / freshman economics class, elementary stuff, it's virtually impossible to get answers to any of these questions from a standard financial statement. I mean, just very big picture. How do you create value? Econ 101 will basically say, take materials, take labor, take capacity, take some managerial talent, and then that's the, by and large, the formula to create some value for an enterprise. But if you take that very basic Econ 101 framework to a classic income statement, it is incredibly difficult to get straight answers to any of these questions. We don't know what are material costs for a company. That's maybe hiding in cost of goods sold. We don't know much about labor. 15% of US companies tell you labor cost. We don't know much about, managerial talent, because that's kind of hard to figure out. We don't know a lot about capacity, because I want to ideally see something like maintenance capex, except we end up capitalizing all capex, and depreciation may or may not be the greatest proxy for maintenance capex. So, and then I'll talk about specific places where I think things can be improved. There's lots of other stuff in the deck which we don't have to go through, but feel free to find me at any time, either in this talk or later. I'm on LinkedIn, and of course you can find me from Columbia's webpage, and I'm happy to continue the conversation. So, big picture, what do we teach in a classic high school economics class? We basically talk about choice of production, we talk about demand supply curves, we talk about elasticity, we talk about consumer surplus, producer surplus, choice, production and cost curves, we talk about market structures, we talk about wages, employment, interest rates, natural capital, taxation, subsidies, lobbying. So it's very, very comprehensive, in trying to understand what lies in that black box called a firm or a company, and how does it create some value. What do we get? This is a standard income statement we get. This is a 6-line income statement that by and large hasn't changed over the last 50, 60 years. And it's not because we figured out all the answers. My worry is that, you know, it's very difficult for investors to get a word through to the FASB, for instance, which is supposedly the institution that writes standards on how public companies in the US should report. And we will talk more about that as we go through the talk. So, for instance, sales. What do I want to see? I ideally want to see some kind of decomposition of sales into price, quantity, and currency, right? It's very difficult to get that information, except in a few special cases. Consider something like cost of sales. I mean, that has materials embedded in it, that has direct labor, that has a whole bunch of other stuff. Very little is decomposed. SG&A, many times companies don't even tell you what is S and what is G and what is A. The same issue with R&D. R and D are different ideas, except I don't know how much R and how much D in most cases. And then, of course, you have depreciation, interest expense and so on, taxes and so on. So this is ideally what I would like to see, because this is hopefully somewhat decision relevant. You want price, you want quantity, you want currency. If you're a multinational, if you have material costs, this is what you want to see decomposed for materials. Labor, you want to ideally separate this out between fixed and variable. This is another important point. The whole technology industry is based on the idea that we spend a lot of money on fixed costs, and then the incremental variable costs of getting to the product is almost close to zero, right? Think about Netflix. You spend a lot of money on shows and content, but the incremental cost of getting you the show through AWS is probably close to zero. It's very difficult to get a sense for what exactly is the cost structure of a company. How much fixed and how much variable, we don't know. Let's talk a little bit about capacity. We see depreciation, which is fine. In some cases, we don't even see depreciation, as you know, if you have things like EBITDA. What do you ideally want to see? You want to see maintenance capex, which is how much capex do I need to spend to simply stay where I am in terms of market share? And then if something adds to my market share or something gives me new customers, maybe that's growth capex. And ideally, one should expense maintenance capex and capitalize growth capex. But what do we do now? We capitalize all capex. So it becomes pretty hard to know what is really necessary to keep the engine running versus what's going to give us growth in the future. And before you claim that this is all a pie in the sky and nobody does it, well, a few enlightened companies do something like this. I mean, this is Caterpillar as an example. The Caterpillar is giving you decomposition of sales, fourth quarter last year versus now. What's the variance because of volume? What's the variance because of prices, currency? Why is this classification important? This is not just an academic exercise. In a globalized world, you can't keep competing by raising prices, for instance. And if you keep making gains because of currency, then you should shut down Caterpillar, you should go to an investment bank and you should trade in currency. So the only hope we have in terms of long-term financial sustainability is probably volume, right? It's the quantity. And there's a similar decomposition here by Caterpillar for profits or earnings over one quarter and a seasonally lagged quarter. So hopefully I've convinced you a little bit about the problems. We can get into more detail, which I'm going to skip for now, and then talk about specific examples where I see problems. So I'm going to spend the next 15 odd minutes maybe picking on these specific problems. And you can find most of the underlying material in Forbes. I write for Forbes twice or thrice a month. So, I'm happy to talk about anything. Okay, proposition one, what is missing? I've kind of already touched on this. It's very hard to get a sense for the unit economics of a business. So price times quantity data and revenue, at least revenue, is missing. A few companies voluntarily shared that information. Apple used to tell us how many iMacs, how many iPhones, and how many iPads, and they stopped because they said, we are now going to launch a services business, and somehow, it becomes hard for the investor to understand or think about maybe price times quantity in services. I don't fully get that argument. Apple stock fell 7% the day they made that announcement back in 2018. And this is not to say that all the fall in the price was only because they stopped the reporting, but it's interesting as a data point to think about this. So this is what Apple used to give us. They would give us unit sales by product, and this is super useful to model. Now, of course, Apple's unique because they have very few focused products. You could ask, how do I do this for a Walmart? Well, you find some other proxy, right? I mean, as an analyst, you're always looking for, when the perfect is the enemy of the good. There's nothing perfect. But you could look for, say, a number of invoices, you could look for footfall, or you could look for, say, square footage and so on. And, I try to supplement whatever I do by systematic research as well. And it turns out in India for a while, for manufacturing firms, we could actually see both price and quantity. So here's a research paper if somebody is quantitatively inclined, where we show that this is important and useful. Only volume shocks or quantity shocks are likely to be more persistent in the long run. Price shocks and currency shocks are not as persistent. So that's, proposition number one, a specific example where hopefully things can improve in the long run. Problem number two, SG&A. I kind of touched on this, and to make it a bit more concrete, Walmart. This is slightly old, like 2021, but we still have this problem. Walmart spends 116 billion on something they call operating SG&A. And I spent a lot of time trying to figure out what is in that number. I could recover maybe $8 billion at best of that 116. The rest, I don't know, right? And it's quite important because, as you know, we have a big issue with intangibles accounting in the US, in my opinion. Some of this is brand building spend, some of this is, coupons or short term volume increasing type activities. It's very hard in general to know any of that. What is the effectiveness of advertising? What is in this $108 billion? Why are analysts not interested in finding out? And this is something else we can talk about. Why is nobody fixing this? My belief is that a lot of it is because of passive investing. So once a company gets into the S&P 500, virtually 20 to 25% of the stock is owned by BlackRock, Vanguard, and State Street. So your biggest shareholder is now basically a computer program. And a computer program, by and large, doesn't care about financial reporting, right? So, if maybe in the Q&A or other forums, we can kind of discuss why these things don't get fixed. Another example, labor cost. 15 to 20% of US firms tell you labor costs. That is finally getting fixed. The FASB has a proposal to disaggregate costs, thankfully. So I'm glad maybe in about 4 or 5 years, this problem will kind of get mitigated, but you still don't see simple, important things that you want to see. What is the average tenure of an employee? How much full-time versus contingent labor? That's a big political problem. People don't necessarily want to discuss gig labor or political labor. What's employee turnover? What are the number of, we get to see a number of employees, but I don't get to see, for example, number of contractors. Uh, Things like healthcare, training. The ESG reporting occasionally picks up some of this, but you still don't see a lot of systematic disclosure for something as elementary and basic as labor cost. Stock options. Now, this is a bit more complicated. When you give cash, it's pretty straightforward. I give you a $10 bill, so the employer basically pays 10, and the employee gets $10. With options, as you know, things get complicated. And there was a long fight, if you remember back in the day, about just booking options. But now that we book options, part of the problem is we're booking the options at the historical fair value, meaning the fair value of the options on the grant date. But if the stock price goes up, we don't mark these options to market. As a result, I use Netflix as an example. The stock price has gone up a lot. The payout that the employee gets is probably 2.5, 3 times more than the labor cost that's booked in the financial statements. So when companies like Netflix and Uber say we are cash positive, we are making profits, yeah, I mean, okay, fine, but with proper accounting, maybe not. So, and this is like a subtle point that a lot of people don't appreciate. If your stock price is going up, labor cost is much higher than what's actually booked in the financial statements. So when people talk about how culture is great at Netflix, I'm sure the culture is fantastic, but if you're paying people a lot of money, maybe it's not unreasonable to expect that people are happy. This is not to discount the value of culture. I'm a huge believer in culture. Another example, R&D. This is my favorite example. When I wrote this, it was like Amazon used to spend 42 bill, now it's like 70 odd bill. When I wrote this piece in Forbes, Amazon devoted 300 words in its 10K to discussing $42 billion of expense, right? And you can say it's proprietary cost, they don't want to tell you stuff, but this is a heck of a lot of money. and now it's like roughly 70 odd bill. And why is, I mean, this is a central problem. I mean, I don't know how much of this R&D is maintenance versus growth, how much of it creates an asset versus an expense, and it also gives companies a bit of a narrative saying, oh, you should not, gap accounting is silly and you should not trust it and so on. And to me, this is like the biggest unresolved regulatory policy problem in US reporting. So much of our business has become less brick and mortar heavy, more services heavy, more intangibles heavy. But our financial statements still behave as though they are stuck in the 1920s or the 30s. And there's lots of opposition, including a few of my colleagues, who I'm never able to convince that we should maybe think about booking R&D assets, because we do this all the time when we do acquisitions, for instance. Um, Technology spend, another interesting problem. Home Depot is a classic case study. They haven't built stores since 2008, but they've done phenomenally well, mostly because of tech spending, right? Mostly supply chain investments, except it's very hard for me to know. And this is a good news story. For Home Depot, the ROI on tech spend must be like crazy, 100+% and beyond or something. It is like so amazing, the story about Home Depot, except very hard for an outsider to know how much money are you putting into technology. So Home Depot is not an R&D company, but virtually every company is becoming a technology company one way or the other. Again, super difficult for outsiders to know what's going on with technology spend. Foreign currency is an utter mess. We've done some detailed work. Barely, maybe the Fortune 50 has a good handle on currency. Uh, it's like a very complicated problem. There are like incentive issues, reporting issues, cash flow issues. We have a whole monograph on that if somebody is interested. But this is another area that just gets ignored because it's too complicated. Anytime the dollar moves one way or the other, a reporter would usually call me saying, can you help me understand currency? And I would send them a big deck or maybe a copy of this monograph, and I would never hear back from anyone. So it's like extremely complicated, very hard to reduce to a soundbite, but very important given that so many of our companies are, highly international. Uh, Counterparty data. This is something else that is kind of difficult to get. I mean, SVB is a good example. Roku, I'm sure some of you have Rokus at home. I didn't know, for instance, that Roku had like $480 million with SVB. So very little counterparty data gets disclosed in a 10K. Now, of course, the feds have it because this is a regulated enterprise and the banking regulators would probably have that data. But an investor doesn't know in general much about counterparties. Other, relatively, we don't talk about it as much as we used to, but, last year there was a big concern about commercial real estate. And if you ask a simple question, can I look at a 10K and can I figure out which bank is likely to have the biggest problem in terms of commercial real estate? It turns out it's incredibly hard. Again, because of a reporting issue. So, of course, the feds have it and they have detailed mortgage by mortgage data, but the average investor doesn't. Acquisitions, another interesting problem. For instance, if I ask you a simple question, Amazon bought Whole Foods. How did Whole Foods do after the acquisition? Well, the way GAAP works in the first year when the acquisition happens, you see a little bit about what happens to sales and revenue with and without Whole Foods, but after that the audit trail gets lost. We never get a sense for how is this company doing after the acquisition. Have the so-called synergies actually panned out, not panned out? So there's a lot of excitement about goodwill impairments and so on, but to me some of that is actually misleading, because if you left the acquisition as a segment, then the market knows. And of course, management knows way ahead of the market that something's going wrong. The market picks up some soft signals, stock price starts falling. Then the auditor has some bargaining power. Then they go to the management and say, look, you should take a goodwill impairment. But it's by and large old and late information that's not super helpful. If the system worked well, the accounting should inform the stock price that, look, these so-called synergies are not panning out. But unfortunately, the system doesn't work well. Most of the impairments are old news and late news, and the market doesn't react because it's already discounted the price earlier. So I'm not sure why we have, I mean, of course, it's very hard to get any give with the FASB on this, because there are lots of interested parties who don't necessarily want the unique contribution from a big M&A transaction to be reported in a timely manner to the market. Segment disclosures, another problem, right? I mean, the related issue to this. I mean, some of the things, I'll just give you a few examples. I mean, the Apple CEO has testified that he doesn't know how much Apple's services business makes, which is just amazing to me, right? So till 2019, Google, for instance, would not report YouTube's revenues. They still don't tell you anything about profits. What's conceptually even more complicated is a company like Amazon, whose whole business model is to run segments at a loss because the whole idea is to cross subsidize. How do you even think about segments that are consistently set up to make losses? Which it's fine. The cross subsidy idea is brilliant and all that, except it's very hard for me to test or know from the outside how much is the cross subsidy. Well, is a particular kind of cross subsidy more effective or less effective? So segment reporting is another interesting issue. So I've asked for a few ideas. For example, maybe we should have a dollar threshold to address materiality. Now, this is a bit technical and in the weeds, but the way this works is that it's reported based on the chief decision maker, etc., in the company. Uh, or there may be other ways to think about materiality. Maybe you should think about products. Maybe the Kindle or the iPhone is material. Or you could think about number of users. Or, what am I trying to get at? What are the unit economics of the company, or even a Kindle for that matter, right? Which is very hard for us to get a sense for. Related problem, subsidiaries, right? To give you an example, HCA Healthcare, the hospital company, has like 1,000 plus subsidiaries. Very hard for an outsider to know what is the business purpose of these subsidiaries, what kind of inter-subsidiary exchange happens, what's the financial position of each of these. Incredibly difficult, right? I mean, other economies in other countries, like India, for instance, make it mandatory for companies to publish financial statements of subsidiaries. Not here, you know. Tax. This is another interesting thing to think about. This is something I've never understood. You can, if you want financial statements for an IBM or an Amazon, I can go to the SEC's website and pull out that data. If I want to see the tax return of a public company, and I'm not asking for your or my tax return, why can I not go to the IRS's website and pull out the tax return for whatever, IBM or an Amazon? And there is no political interest in pushing this through, right, in general. So this is again very bizarre. So how do we even understand what is going on with the tax situation of a company? Well, you get a series of opaque deferred tax footnotes. But in general, from a public policy standpoint, I've never understood why a public investor of a public company cannot go to a place and just view publicly the tax return of a public company. So the flip side to this is subsidies, right? The companies pay taxes, but they also get a lot of subsidies. That's pretty murky as well. It's pretty hard to know government assistance. And I've done some, lots of work in the area. Remarkably, in the democratic states, it's harder to get information about what is being given to companies compared to the Republican states. So, I mean, is the taxpayer money being used well? What's the ROI on that? How many jobs have you created? Why is it costing the state $250,000 to create a job? These kinds of questions are hard to ask if there's no data on subsidies. Comparability, maybe I'll probably skip this because it's very difficult. To me, the best way to think about comparability is the following. Can I take Coca-Cola's, accounting policies and rewrite Pepsi's financial statements and vice versa? That is true comparability, which is very hard to do, probably will never happen, but at least intellectually is worth thinking about, right? Can you ask firm A to report its numbers using the same disclosure practices and policies as firm B and vice versa? That's true comparability. Otherwise, it's so hard. Best worst case financial statements. That's another possibility. When we report these numbers, we give them a sense of there's basically pseudo precision, right? Many of these numbers are estimates. So there's a range. And, like elementary statistics, you want to see some sense for that distribution. And it's very hard to do. It's hard to communicate statistical distributions. So maybe and this is again, it's an idea, it will probably never happen, but maybe we should have companies tell us, here's what happened, and here was like the some best case as financial statements and worst case financial statements, at least in terms of the accrual estimates. There are many accrual estimates, like allowance for doubtful debts, pensions, maybe depreciation. So some kind of scenario-based financial statements will probably help outsiders better allocate capital in general. So I'll stop here. I can go on and on, but hopefully you get the big picture sense of what I'm trying to say. And then I gave you specific examples. It's roughly half an hour since we began. So happy to take any questions, comments, eggs, tomatoes, whatever you feel like throwing it our way. So, and thanks for listening patiently. I couldn't see people. Oh, okay.
Thank you so much. So we do have some questions.
Sure. Awesome.
No
Let's go for it.
tomatoes. We have
No
questions,
tomatoes.
no
No tomatoes.
tomatoes. So first one here is it possible that the bulk of Amazon's R&D is non-public for a reason?
Yeah, I mean the usual story is, as you know, proprietary cost, right? I don't want to tell the world what I'm doing, etc., which is fine, which is reasonable. But if you claim that you are the world's largest, they say that we are the largest private sector entity spending money on research, like 75 bill or something. Don't you owe the investors something? Black boxes are fine until they are not, right? The other point, the proprietary cost idea, meaning something secret, in my mind is highly oversold, right? If I really wanted to figure out what Amazon was doing, first of all, NDAs are not strictly enforced, certainly not in California. Can I not hire somebody from them, maybe a team, and then maybe pay them a little bit more? And yeah, they're not going to, hopefully pass on documents and so on, but they're still going to bring the human capital that they got out of Amazon. So I don't know, the justification for not telling us anything for $75 billion of spend is not very strong in my mind. You may disagree, but at least that's one response. Stephen, could some of the issues raised be addressed if companies reported financial information on product by product basis? Yeah, I agree. I mean, that's another model, right? Because it could be product by product, as I said, Kindle, iPhones. We have to change how we think about quote unquote material segments. It's very hard to write rules, to be fair, right? People will always find ways around the rules. And what is worse is that once a rule gets written, it becomes so difficult to change the rule because there is so much, inertia bias. People don't want to change, and I can understand that. You rewrite your information systems. Who the hell, wants to kind of go and redo it again? It's too expensive. I get all that, right? So we hopefully want to write rules, but better rules, but technology changes too. There's so much bundling, Stephen, for instance, right? So when you're buying an iPhone, what are you buying? You're buying some hardware, you're buying some kind of, payment apps, and you're buying some kind of software. So bundled products become a bit of a intellectual challenge in terms of dealing with your suggestion. But having said that, any new thinking on this topic would be hopefully helpful and will push things through. My mission is to, try to tell people that, look, the stuff is not good. We are the world's leading capital market. People often have the impression that US reporting is fantastic. US reporting is not fantastic. There are like many other things one can do. And why is nobody bothered? I mean, I think part of it is a passive problem. Part of it, in my opinion, is that the FASB, regrettably, is probably overrepresented by CFOs and auditors and underrepresented by investors. So if your biggest, as I said, your biggest shareholder is a computer program, the computer program has very little interest in policymaking. So let's see. Yeah. So Stephen, I agree, subject to the stuff I discussed.
And
Jason.
then our next question is Jason
I
Shell.
love Jason because he loves my ideas. But sorry, having said that, would your concerns also, yeah, off-balance sheet financing, huge. I fully agree. Fully agree. Part of the stuff is hidden in subsidiaries. Part of it, yeah, off-balance sheet. I'll give you an example, Jason. Netflix on balance sheet debt is roughly, I want to say 20 billion. Off balance sheet debt is as much. Now, it's probably not super surprising for a Netflix because, once a show does well, then they immediately go and sign the studio for a sequel. Uh, but it's a big number to keep an eye on. And somebody joked that Netflix is basically Debtflix, right? Like $40 billion of debt on and off balance sheet combined. Yes, yes, it's just, sometimes I worry the FASB is not responsive enough. Of course, financial engineering, there's always going to be a big market, right? People are always going to find ways to hide debt and taxes. But you also can't have a system where you take 10 years to write new rules. The leasing standard for the FASB basically took 10 years. That's a long time. Karen, what are the differences between GAAP and IFRS? Interesting point. I think GAAP is highly rules-based, our system, partly, as you know, because we have more lawyers per capita than doctors or teachers. IAS, the European system, arguably is more principles-based. Uh, there aren't like violent differences between the two, except for a few cases like R&D, for instance, because the Europeans, IAS, they let you capitalize the D and expense the R. But it turns out empirically, if you look at the data, the vast majority of European companies continue to expense the D, although they don't have to. That's an interesting curiosity as well. But the big picture difference is principles based and rules based. Is one better than the other? I think the IASB, which is the regulatory body in charge of IAS, in my experience, is a bit more open to debate, dissent, and scholarly conversation. Unfortunately, I think the FASB is not. So there's also a bit of a philosophical difference in how, you know, how open are you to debate? And of course, the FASB will not agree with what I'm saying, but that's at least my personal experience. Um, John,
John,
why
go
don't
ahead.
excellent question, John. Why don't equity analysts ask these questions? I don't know, but I can hypothesize. It's partly the passive problem, right? So who pays for equity analysis? Active funds, but the share of active has gone down substantially. So at least in the sell side world, arguably, the I mean, I haven't tested this, but my conjecture would be, compared to at least when I started my career 30 years back, the quality of equity analysis is probably not as good as it used to be for all kinds of. Now, buy side, I don't know about the buy side. They never talk to us in general. But even if you look at the buy side, the Fidelities and the T Rowe prices and so on, I've heard some of them say, "Oh, we are a long-term investor." And if you ask them, "How long do you hold a stock in the active portfolio?" They'll say 18 months. So you make up your mind whether 18 months is long-term investment or not. Uh, so this is interesting. And the other hypothesis I have for you is that equity analysts are almost too obsessed with what's going to happen the next quarter. A lot of the conversations that we are discussing are arguably longer term problems, but who has a long term horizon? And if you tell me the index makers do, not really. The index makers care about a stock as long as the stock is in the index, which opens up the other bigger conversation we should have. The index maker, in my view, is the uncrowned king or queen of Wall Street. Very little conversation happens around the enormous power that the S&P 500 committee, for instance, has. We can have a conversation about, algorithmic indexes and discretionary indexes. If the index list is simply created by a computer program, that's one thing, right? Very similar to say what Russell would do. The S&P committee uses discretion, and if somebody wants to, we can have a conversation about that, right? Denise, why would the most effective way to push FASB to act on behalf of a non-institution? What would be the most? Just being interested in accounting. I'll tell you, I mean, when I write op-eds and send them to the Wall Street Journal, they'd say, this is accounting and not interesting to our readers. If the Wall Street Journal is not interested in accounting, I don't know what to do, right? So part of it is, and of course, part of it is our fault because the profession, I think, has uh, one of the entry barriers is gap and gas and so on. So the more technical you make it, the difficult it is for outsiders to access the debates, and hence you create barriers to entry, and that's a source of rents. That's probably one hypothesis. As a result, only one expert is talking to the other expert when these things are going on. Retail, by and large, doesn't care, and perhaps shouldn't, because you should simply hold the index. But for the system as a whole, when you have this much passive investing and too many experts dominating the discussion as opposed to anyone else, you know, accountability suffers in the system. So just being interested in the area and, for example, will there ever be a signature campaign asking the FASB to do anything? No chance, right? So I wish there was, but there isn't. Um, Anonymous attendee, is there any history in the US of access? Yeah, that's a good point, so I don't know, but I'm guessing some of the Scandinavian countries will let you do that. Of course, they have a different social contract. We don't even have to go that far. What I can't understand is you're taking public money. The social contract is that you tell us what you did with your money. That's why we have 10Ks and 8Ks and Qs and all that. Why not for tax returns? Right? The IRS is hopelessly outgunned. It doesn't have the money or the time to do, all kinds of audits for various companies. Wouldn't the system as a whole benefit if a whole bunch of people looked at tax returns for companies, like say short sellers, students, professors, whoever, right? Media, whatever happened to more sunlight and all that, right? So the answer, I guess, is maybe the Scandinavian countries, but it's surprisingly not common, and I don't know why. It must be lobbying, I guess. Uh, Private meetings with investors, most of this information is given to them if asked. How much information have you been given to do? Well, that's another. So, do you really want that, right? To this person, why not to the public and why just to private? So, if everything is private, we can stop disclosing sales. We can give that in private meetings too, right? So, where does one draw the line between what should be public and what should be private? And if you're that concerned about privacy, you should simply be a private company, right? Maybe that's why private equity is taking off and doing well. So, I mean, I see your point, but it's an interesting issue, right? Why just private? Why just to specific institutional investors? Where does one draw that line, right? Whatever happened to Reg FD, for instance? Uh, are there countries with more informative financial reporting? The balance between disclosure and reporting burden is XPRL used. So XPRL is useful, but I think is a somewhat highly oversold, in my humble opinion. Uh, it's better than nothing, but it is not the magic wand that it is often touted to be. Are there other countries with more? Well, I think the European reporting is much better. When they do show you labor costs and material costs, like pick a Unilever, for instance, or something. Um, and now I know ESG is like a three-letter word, a bad word in our world these days. But the Europeans also do a fair amount of good reporting on things like, say, employee turnover, what's the average employee tenure, how much do you do in terms of training, elementary stuff. I'm not even asking for the, more complicated, controversial CSDD type stuff or CSRD type stuff. So the European model perhaps is better. And I often write, India is not bad, in terms of disclosure. Now, of course, we have governance problems in India, so I'm not trying to be naive, but there are other settings from which one can learn, you know. In certain cases, even Chinese reporting is actually pretty good. So, David, what are your thoughts on Coinbase MicroStrategy letter to the IRS and the FASB's Feb AMT on Bitcoin? Uh, I don't know, David. For the longest time, I'm a fundamentals guy. I guess that's why I'm at Columbia. And the best thing I heard about, how do you value crypto? The best model I've heard is that it's a function of future demand. Now, to me, that's not a model, it's a tautology. is nothing, right? So I've never invested enough time in learning about crypto. Maybe I should. Uh, so this is one question where unfortunately I have to plead ignorance. May not be able to give you a reasonable answer, but I'm happy to go investigate. Coinbase is interesting. A lot of the ex-SEC people are now at Coinbase, which is the other interesting thing we should, if somebody wants, we can discuss the whole revolving door problem. We underpay, people in places like the SEC. So I've written a piece saying we should add a zero to everybody's compensation at the SEC. Like, somebody who's in charge of maybe $1 trillion industry is being paid like $150,000. This is like silly and ridiculous. I mean, Singapore does a fantastic job. They're paying its good civil servants and the more skilled ones a lot of money. So public service is all well and good, but if the wage disparity between the public servant and somebody outside is like 10x, then we're going to have a big policy problem, which is probably what's going on sadly with the SEC. What about private equity? This is Denny's fantastic point. I'm in the middle of writing a piece. Private equity is very private. It's pretty opaque, so it's very hard to know what they actually do. But there's a small window, perhaps. So there are these companies called BDCs, Business Development Corporations. You can just Google them. So, and they've been around for a while, and they trade. So, and they put out financial statements. So that's a window into private credit and private equity. So I'm writing a piece and I'll post something online. But in the meanwhile, if you're interested, just look for BDCs. And of course, this is an important point you're making, Denise, because private equity and private credit are very soon going to come to a 401k near you, right? So of course we have Bitcoin ETFs, I guess. So you could ask me how crazy can things get? But still, private equity is pretty opaque. And before we end up democratizing it to the extent that we are planning to, uh, I don't know. We had a robust conversation around the pros and cons. It's pretty illiquid. It's fairly opaque. Uh, somewhat hard to verify. After fees, are you really beating the market? How do you come up with a public market equivalent which makes some sense? Should we trust the IRR numbers? So there are lots of questions in private equity. In general, I respect Jamie Dimon's disclosure. No, you're fine. I mean, JP Morgan, there's a joke going around, which I'm sure you know about, and I don't want to offend anybody, but since you raised Jamie Dimon, JP Morgan's balance sheet is incredibly opaque, very difficult to read. I mean, partly because they're a very complicated company. And again, this is a joke in good spirits and not meant to offend people, but the joke is that JP Morgan is so complicated that even God can't run JP Morgan. Thank God we have Jamie Dimon. So, in that sense, it's a very difficult business to understand because banking and insurance in general are arguably the hardest business models and financial statements to fully get a sense for. So, but of course, he's legendary as a corporate leader. So. Stephen Gray, if you take into account the amount of money invested via passive, how little, I fully agree. Doesn't mean that the market, no, that is true. So there are two comments here, Stephen. One is what is passive doing to market efficiency in terms of pricing, which we can discuss, and what is passive doing to governance? I think it is doing very bad things to governance. Effectively, nobody is in charge because the counterparty is a computer program. Occasionally, we'll have an Elliott or a Trian, which kind of goes and rattles the cages a bit. And I'll send you some work I did, Stephen. In the S&P 1500, the last time I looked, barely. I mean, there are like 200 or 250 companies, or even more, maybe close to 300, that haven't even beaten U.S. Treasuries. Okay, haven't even beaten U.S. Treasuries for the last 10 years. So that's bizarre, right? What's going on with governance? Forget the CAPM, forget anything fancy in terms of asset pricing. They haven't even beaten U.S. Treasuries. So in terms of governance, I think passive is having a fairly big unintended impact, a negative impact. In terms of pricing, the jury is out. For example, if you listen to people like David Einhorn, and there's a gentleman called Mike Green who had come to my class and did a fantastic job, basically making the point that in finance we teach that somehow demand supply for stock doesn't really quite work, the downward sloping demand curve, because we teach students that look, it's the present value of future cash flows for the stock. But with passive, that's no longer true, because each of us is sending a check every month to buy the S&P 500. So he made the point that just the inflows to Vanguard is as good as many hedge funds creating buying demand for the index. So it's not obvious to me that passive is not doing anything to market efficiency. And to your point, there must be more opportunities on paper, yes, but you can't fight the tsunami of dollars on the other side of the trade, right? So that's to be discussed and debated. And I can send you a couple of things that I've looked at, which seem to cast doubt on the idea that this is creating opportunities, or at least somebody's exploiting the opportunities. It's probably creating opportunities. We always have these interesting conversations about what is peak passive and so on. But some of the new work coming out, at least even in the academic world, is casting doubt on the idea that passive is not doing anything to pricing. It probably is, like big impacts. Uh, but happy to chat offline and send you some stuff if you're interested. And feel free to disagree. The point is to have a conversation. Eduardo, interesting talk. Oh, thank you. What do you think is needed to change the third-party relationship between SEC rating agencies, public companies, investors? It is a good problem. Well, what do we need? At the very least, we should probably push the FASB to be a bit more responsive to investor needs. I wrote a piece which I'm sure they were not happy about. After every class at Columbia or any good institution, students fill in a teaching evaluation saying the professor sucked, was like, couldn't figure out his accent. He was like, whatever, right? When was the last time we did any of that for the FASB? I mean, has any investor actually filled out an evaluation survey, a satisfaction survey? So some of our regulatory bodies, in my humble opinion, have become a bit unresponsive and somewhat unaccountable. So maybe that's one answer to your issue, Eduardo. Um, Rating agencies, I mean, that's an interesting conversation we can have. So a lot of the rating agencies have become, basically, why are you buying a rating? It's become a compliance job. Is the rating really informative? I mean, there's tons of work which shows that rating agencies tend to be slow in downgrading debt. I mean, go back to SVB, for example. Both Moody's and S&P had rated them as investment grade, even before, bad stuff happens. So the only people who have any skin in the game to figure out problems ahead of time are short sellers. But because interest rates are what they are, meaning being relatively low from a historic standpoint, a lot of short sellers are going out of business. So, you wonder about rating agencies. I mean, the SEC, SEC, again, this, right? Every commissioner basically has like 2, 3 years to do something and can focus on like 4 things. And if you get too aggressive, then you get lobbied and thrown out, which happened the previous time. So it's a complicated challenge. Maybe one simple recommendation would be, you know, increase investor representation at the FASB, because right now I think the narrative we often hear is that it's too expensive. Any change is too expensive. I perfectly agree, but I'd like to see some data, how expensive, and what is the, why are investors not interested? Well, because of the issues we discussed. Passive is not super interested. Analysts over-focus arguably on the short run. So there's potentially a market failure, arguably. Uh, Anonymous attendee. In Egypt, we have random financial DDs carried out by, oh, I see. You mean like audits? Uh, so I think the tax authorities in the US, at least for large companies, usually have staff on the premises throughout the year. So if you're looking at, say, a Microsoft or a GE or a GM, I suspect the IRS has people on the floors. I mean, like, that's another interesting conversation, maybe time, just like another webinar. So, what is the proportion of taxes paid by individuals and companies in the US? It used to be, if my memory serves me right, something like 70-30. 70% of the taxes were paid by individuals and 30 by companies, like 30, 40 years back. And now it's like 90-10 or 91-9. And clearly, corporate profits have gone up a lot. So the amount of gaming that happens in corporate taxes is so high. I would argue just make the tax rate zero. All it does is to keep lawyers and accountants employed. There's so much energy that goes into tax planning. And that's why I'd written the piece about the ESG thing, right? So most directors would say, yes, we should pay labor fair wages, maybe higher than fair wages. We should be good to the community and so on. But when it comes to taxes, somehow something happens to them and they want to just minimize the amount of taxes paid. So you don't have to do any ESG, just arguably pay your fair share of taxes. Or you could say, oh, that's a vacuous statement. I don't know what fair share means. But all I'm trying to say is that the amount of energy that boards and management spend on minimizing taxes is extraordinary. And socially speaking, I'm not even sure it's worth the effort. Just make the corporate tax rate zero. Perhaps say that maybe stick in 15% more in an employee's 401k as a bargain. Maybe that's not such a bad bargain. Um, Anthony, are you familiar with the AI? Yeah, AI is interesting, Anthony. So I'd written a piece about AI. So I'll give you my experience with AI. AI is interesting. It's good to kind of synthesize a lot of information, but AI is also complicated, right? I mean, it reduces rote work and drudgery in my experience. So, for instance, if you type in something like this on ChatGPT, is Tesla a buy? Now it'll give you a very eloquent, like 15-point response on how Tesla is fantastic and we should buy Tesla. And you turn around and ask ChatGPT, is Tesla a sell? It'll take the same points and rewrite them and claim Tesla is a sell. So ultimately, the decision of whether Tesla is undervalued or overvalued has still got to be taken by a human being. And increasingly in classes and other settings, people are using a lot of ChatGPT, and it's fine. But is the system good enough for us to delegate investment decisions to? I'm not sure. Can it figure out shenanigans? There are papers. So, as you know, Anthony, the problem with these things is that they work very well in sample, meaning whatever you train the algorithm on, it's obviously going to do a fantastic job. Once you go out of sample, not sure, right? Because the people who commit shenanigans are also changing their game. So, yeah, I guess the jury is out on that. I haven't seen stuff that have been like mind blowing or anything. Some of the academic work on this topic, AI, does it find shenanigans? When people started poking holes in the methodology, it kind of fell apart a little bit. So, not sure. I don't think it's there where it probably needs to be. Uh, Edwin, gap appears to change from one year to the next. What is driving these changes? Well, that is interesting. You can ask, what is on the FASB's plate and who decides that? A lot of that is arguably incremental, small changes. So in the deck, and I'm happy to share the deck, I had a slide on what the FASB's agenda looks like. There are lots of changes, but are any of those big changes that will address stuff that I'm raising? Except for breaking out expenses by materials, labor, etc., which is a huge advance, and I'm very grateful for that. None of the other stuff is on their agenda, by the way. So there are lots of changes, but are they impactful, meaningful changes? Is the question. Uh, Samir, up to what extent are all these issues of undisclosed information regulators not enforcing? It's a fantastic point. It's a bit of both. Uh, for example, I'm sure the SEC prodded Amazon for the longest time and maybe didn't succeed. Maybe they prodded Google, and finally Google is now reporting at least revenue numbers for YouTube, but not profit numbers. So some of it is poor enforcement. And it's fairly well documented that after 9/11, when the terrorist attacks happened, the entire law making and enforcement machinery switched to worrying about terrorist financing and so on. So some of the focus on accounting enforcement and auditing enforcement fell, and frankly has never recovered because other things happened. There's Bitcoin, there's crypto, there's always new financial engineering and technology that keeps marching on, and the regulators' resources, to be fair, are constrained and getting even more constrained because of Doge and so on. So some of it is lack of resources for enforcement. You know. Jenny, I have a technical question. With the tariff, sorry, I misread your point. Tariff chaos, inventory on hold, value of inventory when it truly landed versus in a bonded location. When should this deferred tariff show up on the balance sheet? Ooh, okay, interesting point. So there's inventory, the value of the inventory when it lands, duties paid versus in a bonded location. When should this, well, shouldn't you simply revalue the inventory if the tariffs have gone up? Or maybe I'm not understanding your question. Uh, a related question that came up was the idea of you using the retail accounting method to value inventory. Basically, you take the sale price and you subtract some kind of average margin, except those margins were calculated in a pre-tariff world, but now it's going to be different with the post-tariff world. So you can't even use retail margins. I think Walmart won today on a related point. They're saying because of the fact that they use retail, the retail method of valuation for inventory, the whole tariff chaos is going to create volatility and the inventory number. And if you're a retailer, the inventory number is a big number. So without thinking too much about it, I would simply say you have to revalue the inventory, but I need to think more. Elisa is basically giving me dirty looks and saying, time to stop. Okay. John, what's the best way to follow your releases? Oh, I'm so flattered and grateful that you are interested, John. So I write for Forbes. If you don't mind, send me a LinkedIn thing, and I usually post that on LinkedIn. But thank you for the interest. Um, Lionel, can the external auditors be de facto independent? Oh, good question. Very interesting problem, which we can talk about. Maybe that's another webinar. So many interesting questions for Elisa for a future webinar. This is actually this is something worth thinking about. Are audits really independent? And this is a very topical point that you're raising because the new administration is thinking about effectively absorbing the PCAOB into the SEC. So good time to discuss audits, right? I have written a piece saying who audits the auditors. Uh, but I'll send you the stuff if you want. Lionel, send me a thing. You can find me on Columbia or other places. But to be discussed. You are right. I'm not sure, frankly. Mm. Sharif, do you think there's an incentive not to hide debt? Of course, there's no incentive. Like the only thing, there's always a market to hide debt and taxes. So, uh, Marissa, thank you. Given the evolution of market structure, financial, what is your outlook on the ability to generate excess returns in the future? That's a good question. I think the half the reason I'm worried about all this is because, quote unquote, value investing is becoming tough. So we have explored many reasons why value investing may not work. I think the underexplored reason is passive. Passive is the reason in my mind why value doesn't work. Because, since 2008 or 9, when interest rates started going down, in my mind, we've had one long momentum trade. And momentum trading is not fundamental investing. So unless something breaks around those lines, on the one hand, you can argue fundamentals are always going to be important. Value is one way of thinking about fundamentals. Maybe we have to worry about growth investing, or maybe worry about who gets into the index and who gets out. I'm sure, somebody told me that's like the biggest trade on Wall Street. Just guessing what's going to get added to the index and what's going to get kicked out. So what is the future of fundamentals investing? It's an interesting problem. I can tell you that the number of sections we offer at Columbia is going down for fundamentals investing. So are young people as interested as they used to be? No. Uh, that is a concern, for our area in general. Mm. So you or someone armed with so anonymous attendee, I'll share a story. This is recorded, but what the heck, right? So one of the SEC commissioners who's not around anymore did nominate me for the FASB, and you know I didn't get in. So you can make up your own mind why. Uh, anyway, but but more than anything else, I'm so grateful that people are interested, because, right, this is not a management talk where I tell you happy stuff about how to motivate employees and so on. Like, it's a technical conversation. You have to be a little bit in the weeds to appreciate what I'm trying to communicate. So I'm very, very grateful. More than that, I didn't want to let down Elisa and the alumni. So I'm happy at least some of you were interested and so engaged. Thank you so very much.
Professor Rajgopal, thank you so much. You are a delight to hear from, and this was so, so fascinating. Everyone joining, we will share the PowerPoint, and we can share with the professor your contact information if you'd like to
Absolutely.
have a conversation with him offline. Just to
Find
quickly,
me, find me. I live on the Upper West Side, close to Columbia. If you're around, happy to have lunch, breakfast with anyone who has any interest in the topic.
would
You
you
know.
like a job in alumni relations?
Oh, me? I'm busy enough,
We'll
Elisa,
put
but
you
but
to
I'm but I'm
work.
but I'm happy to help you.
Well, thank you again, Professor. Thank you to everyone who took the time to be with us. We're so just pleased that you took tonight and we're here to listen to our faculty. Please do keep an eye out for future upcoming CBS Faculty Live virtual talks. More will be coming, okay? So thank you so much.
Thank you so much again, everyone. Take care. Bye.